On behalf of Nomura, we would now like to welcome you all to Justdial's Q1FY21 earnings call. Today we have with us the founder, MD and CEO of Justdial, Mr. V.S.S. Mani, and the CFO of the company, Mr. Abhishek Bansal. Without further delay, I would now like to hand over the call to the management. Over to you guys.
Hi everyone. Welcome to Justdial's earnings call for first quarter of fiscal 21. Operating revenue for the quarter stood at 162.4 crores, which declined 32.4% year-on-year. This drop was primarily due to lower collections in June quarter and previous quarters, and partly due to impact of certain customers opting for pausing services or delaying their activation of their campaign during the lockdown period. Operating EBITDA, adjusted for non-cash ESOP expenses, stood at 46.3 crores for the quarter, declining about 33% year-on-year. However, considering significant impact in top line, tight cost controls enabled us to achieve 28.5% adjusted EBITDA margin for the quarter. Other income for the quarter was substantially higher at about 76.9 crores due to fall in bond yields, resulting in MTM gains on our treasury portfolio. As a result, net profit for the quarter stood at 83.3 crores, growing 45.5% year-on-year. Coming to operational highlights, we had overall 100 million unique users for the quarter, which dropped 36% year-on-year and 28% sequentially. This drop was primarily due to lockdown impacting our traffic from the end of March. To optimize our discretionary costs, we had curtailed our advertising spends, both digital and non-digital, from the month of April. For April, our average traffic dropped about 48% versus pre-COVID levels. However, traffic has been recovering reasonably well since then. For the month of July, average daily traffic was down about 12% versus pre-COVID levels. However, since majority of traffic is presently coming organically without any advertising, on a like-for-like basis, July organic traffic has already passed pre-COVID levels, which is a healthy sign. Total active database now stands at about 29.6 million listings, a growth of approximately 12% year-on-year. Paid campaigns at the end of the quarter stood at about 445,000. Essentially, during the lockdown, several customers have opted to renew their contracts at a later date, which is what impacted sign-ups during the quarter. In order to assist SMEs in these unprecedented times of COVID-19, we had launched various offers on our paid campaigns during the period, including better discounts, flexibility in activating their campaign, better payment terms, etc. As a result, we were able to arrest COVID-19 impact on our 1Q monetization to a decline of about 52% year-on-year and 43% sequentially in our collections. With lockdown easing, monetization is improving, and the impact of any revised lockdown or restrictions in certain geographies, especially tier 1 cities, is being monitored very closely. Coming to cash and equivalents, that stood at about 1,643 crores as on June end, growing about 17.6% year-on-year. On the ongoing buyback for rupees 220 crores, we expect to be complete in another 4 to 5 weeks. Overall, as we all know, the quarter was expected to be a tough one owing to COVID-19 impact. However, we think we have been able to perform fairly okay in terms of monetizing as much as possible, and at the same time controlling costs strictly. There is a lot more focus on automating internal processes going forward, which should ideally help us emerge even more stronger from this particular pandemic. With this update, we shall now open the floor for any questions. Thank you.
Thank you so much, sir. With this, we will open the floor for Q&A interactive session. For participants, if you wish to ask a question, you may please press 0 and then 1 on your telephone keypad and wait for your line to be unmuted. I'll repeat, you need to press 0 and then 1 to ask a question. First question of the day we have from Pranav from Edelweiss. The line is unmuted. Please go ahead. I'll repeat, Pranav from Edelweiss. Your line is unmuted. Please go ahead.
Yeah. Am I audible now?
Yes, you're audible.
Yes, please go ahead.
Yeah. Congratulations on a good performance. My first question is on the traffic. You said that in July your traffic is almost back to pre-COVID level. So from that perspective, how significantly the collections have come back? And secondly, on the cost front, we were expecting a slightly structure, because I believe that in the last earnings call, we were expecting almost 53 crore cost per month to come down to almost 35 crore per month. It seems slightly higher at this point. So how should we see this going forward?
So Pranav, firstly, on the July collections. So July collections are approximately at about 60% of pre-COVID levels. Traffic, as I mentioned, that excluding advertising has come back reasonably well. But monetization obviously will depend on how lockdown shall open up in tier 1 cities. Even at this point of time, there is limited activity that is being permitted in tier 1 cities specifically. And otherwise also, SMEs obviously are taking a cautious stand in terms of trying to get a grip on their business first before committing any sort of advertising spend. On the cost side, so the P&L expense recognition has certain other particular costs as well. For example, my incentive cost in P&L it is expensed in line with revenue recognition, whereas my cash incentives paid out during the quarter would have been lower. So while our cash costs were around say 35-36 crores a month for April, May, they were slightly higher for June because things started opening up. Since traffic came back, some of the variable costs linked to traffic have started coming back. They are ballpark in the range of about 38-39 crores a month at this point of time. Some of these particular costs could come back depending on how monetization scales up.
Yeah, just a quick follow-up on that. Can you give us, some color, because on how should one see this, given the traffic is already at a pre-COVID level, and this is coming back despite the lockdown. So how should we see the collection coming back? Because the traffic has come back to normal level, should we assume that in let's few months it should be coming back to the pre-COVID level? And similarly on the cost, how should we see the cost in the P&L for the next quarter or so?
Also, Abhishek, compare the traffic with advertising and say what's the level, and give a clearer perspective.
Right. So traffic, as I mentioned, that with advertising, July was approximately 12-13% down versus pre-COVID levels. Coming to your question on
without advertising?
Without advertising, it was up about 6-7% versus pre-COVID levels.
Okay, so can we start advertising now and come back to normal business, or is there something else to it?
So, couple of things here. Firstly, on advertising, the thought process is that obviously we would want to have some clarity on where our particular monetization is trending. Very importantly, in tier 1 cities, several of our customers, even at this point of time, say that while we might actually get inquiries from Justdial due to lockdown and several restrictions, we are not able to cater to those inquiries. So for us, as far as advertising is concerned, we are taking a calibrated approach to see, one, how market opens up, and second, how our particular monetization is trending. On the question of how do we expect collections to trend in coming months, we already have guidelines which have come up till 31st August from the central government, and respective states have also started issuing their guidelines. There isn't too much of a change versus what we had in July. So it seems that it will possibly get into September or maybe even a month later before things start opening up at a broader scale. And once those things start opening up, post that, I think it will take probably few months before things start resuming back to, say, original activity levels. Just as a very Basic example, like as Justdial as a corporate, we were advertising anywhere between 13 to 17, 18 crores a quarter pre-COVID. And at this point of time, when as a corporate, we are also taking a cautious stance, when we are also trying to get a grip on our particular business before committing funds to advertising, probably similar would be the behavior for a small or medium business as well. Pranav, to your question on the cost side, so on a monthly basis versus pre-COVID, our costs are down approximately 14-15 crores a month. The broad split there is around 7-8 crores have been saved from salary expenses, another 1.5-2 crores on incentives, about 4-5 crores on advertising, and another 1.5-2 crores from other optimizations. So as I mentioned that some of the costs pertaining to advertising, etc., they will come back in a calibrated manner. However, some of these particular savings are expected to be sticky in nature going forward.
Okay, thank you so much. Really helpful, and all the very best for the next quarter. Thank you.
Thank you.
Thanks for your question. Next we have Vivekanand Subramanian from Ambit Capital. Your line is unmuted. Please go ahead.
Thank you very much for the opportunity. I have two questions. One is on the tier 1 versus tier 2 performance. Presumably the business metrics in tier 2 towns, given the nature of lockdown being so severe in the big cities, presumably the contribution would have picked up even further. So can you discuss about the revenue contribution, the campaign split, and the behavior of SMEs in big cities versus your tier 2 cities? That's point one. Second, Abhishek, thanks a lot for discussing about the cost structure. Can you talk a bit more about how much more automation can you achieve in your internal processes? Because I can see that the headcount has declined meaningfully. How much of this 14-15 crore per month cost savings is lasting? Assuming that we don't have any color on when the business will come back, but we just want to understand when the business does come back, what is the likely operating cost structure that we will have? Thank you.
Right, Vivek. So on the first question on tier 1 versus non-tier 1 cities, so you are right that tier 2, tier 3 cities continue to gain share. So at this point of time, they contribute about 34% to our top line, and in terms of count of campaigns, about 55-56%. So definitely tier 2, tier 3 cities are faring much better compared to tier 1. On your second query, as far as the extent of automation, so internally the key thought process is that as many functions, as many processes we can automate, that will help us in the long run. That obviously is going to be an ongoing exercise. The key takeaways for me from the cost structure is that even when top line has dropped by about 32-33%, we have been swift enough to ensure that business was still able to deliver 28.5% EBITDA margin. So earlier when top line was very healthy, at that point of time we used to have 28-30% EBITDA margin. Having said that, once top line growth returns back to normalcy, I do expect that margins should be much healthier versus what they are. Versus the 14-15 crore monthly drop that we see in the cost structure, definitely 30-40% of those could be long-term sticky in nature.
Okay, understood. Just a small follow-up on the tier 1 versus 2 discussion that you had. So what is the share of traffic and overall listings that these cities have? They now contribute meaningfully to your top line and campaigns. And what are you doing right in these markets? What's working for you? And secondly, if you could give, I know that things are very challenging in top 11 cities, but if you could give some update on the initiatives that you are planning on the B2B and the transactional B2C side to improve your revenue in tier 1 markets, that will also be great. Thank you.
So in terms of splitting listings, around 55% of the listings are in tier 1 and the rest of the listings are in tier 2, tier 3 cities. And the split in terms of the traffic that the portal attracts, traffic also is by and large similar. So that is the share in terms of traffic and listings. Coming to growth in tier 1 versus tier 2, tier 3, tier 2, tier 3, obviously we enter these particular cities with a very lower ticket size. So the ticket size in tier 2, tier 3 is obviously much lower, almost 40-45% of what we have in tier 1 cities. So that obviously makes that particular listing much more attractive in these particular cities. Secondly, obviously the base effect in terms of tier 2, tier 3, we have penetrated these particular markets at a much later stage. And in recent months, tier 2, tier 3 cities have started opening up much earlier compared to tier 1 due to this particular lockdown impact.
Okay. And could you answer my question on the initiatives, longer term initiatives to grow your business in tier 1 cities, B2B and transactional B2C? So, I know they are on hold, probably they may be on hold right now, but what are you doing at the back end?
Yeah, I'll take this question. Sure. So a lot of it has been like kind of, it has gained momentum. And since the COVID time, we've kind of hesitant to bring in much more changes from our end. Although you're right, a large section of our categories in the services side will be on transaction basis. And some kind of a service that people could avail via Justdial lending the guarantee of the service. And on the B2B front, there is a separate initiative to catalog every product that is there in B2B and create a marketplace, for which we are doing within Justdial. You'll see a lot more content enrichment and a separate portal. Now, the thing is, the initiatives are quite a big list. We don't want to share with the market anything as such right now till things get back to some kind of normalcy. What are we worried about constantly is that when will this lockdown end? When can our sales force hit the field? When can our customers do their regular business? And that is where the biggest concern area for us. As far as those initiatives, other initiatives are concerned, they are in full swing because that department, product and technology, is doing its job. And you will see them as they get rolled out. We will be announcing it to the market.
Yeah, thanks, Mani. That was very useful. Last small question: is there a big difference between the premium and non-premium listings proportion in tier 1 versus 2 and 3 markets? Is that the result? Is that resulting in your ticket size being so different in these 2 markets?
No, it's just the geography. If larger the geography, the ticket size are higher, the competition is higher. Market forces determine that. Tier 2, tier 3 cities, certain categories you can't monetize beyond a point because of the nature of those cities. So it's basically, it's less to do with anything to do with product and pricing. It's pretty much the same, Abhishek. The ratio of premium contribution to
ratio would be same, but to say for the same category, say a pest control service in Mumbai versus a pest control service in Kanpur, for premium position in both the geographies, Kanpur would be much cheaper compared to Mumbai, solely because Mumbai attracts much more traffic, and even for those service providers, the ticket size for their particular service would be higher in Mumbai versus say at Kanpur.
See, there has been a particular way that we have been monetizing our search traffic, as per keywords. We want to transition into a good blend of certain keywords are monetized only on the basis of percentage earned on transactions. Certain others are probably monetized only on a lead basis, and some others continue to be accessed right now, which is on listing. So this transition is important from various point of view. One, first it all begins with the user experience. We are focusing on what users like, and we need to transition that. I think we are a bit late for that, but late in the sense we have to do it like yesterday, right? So those transitions should happen in certain keywords. Like Abhishek gave a good example of a pest control service or a AC repair service. There is a general consensus among users that you rather give the task to JD, Justdial, and Justdial kind of execute it for us through a vendor. So there's a kind of assurance for the quality of service. So that is something. So those kind of services are going into a different pocket right now. Where actually speaking, you may not even talk about any more premium listings and non-premium listings. You want to tie up with the best of the best players, the best rated guys, and give them as much business as possible and monetize maybe much better than what you do today, but with a very small set of businesses. I hope I'm not confused you on this. Which is where the opportunity is. For example, if you generate 1,000 search leads for pest control services, there's a particular way that we monetize in terms of showing search results and multiple listings and things like that. Now, if we kind of take those actually into transactions and make a percentage of the commission, then the model changes. Okay, but are we right now executing it? No, we want normalcy to prevail first, and then we want to go and take a leap on it. So there are concerns about our business. Let me address that. From a perspective for most investors also, as a going concern, will this concept, will this company continue to exist, in the future? Of course it will, but it has to also evolve from what it is today. See, our strength is, look at this, 500,000 businesses trusting us, which means obviously there is a big brand, there's a big advantage of being part of their style, and many of them have been with us for years together. Okay, they've grown with us. Now, because of the changing ecosystem, changing user behavior, and the post-COVID era, everybody has to change, including our vendors, us. All of us have to change for a better experience. So this transformation will happen soon, but before anything else, normalcy should prevail. In this current what we're going through right now. Right now we're all locked down. I mean, a large percentage of our workforce is about 80% of them are at home. And whatever little work we can do from home, that's what is happening.
Thanks a lot, Mani. That was excellent, and wish you the very best with your vision in this transformation journey.
Thanks so much.
So we'll go ahead with the next question coming up from A.R.S. Motiwala from Novices Partners. The line is unmuted. Please go ahead.
Yes, hi. Good afternoon and good evening, gentlemen. My name is A.R.S. Motiwala. I have two questions. One was when I got muted off when the cost control explanation was being given, and Abhishek, if you can just quickly go over it. The question was about 50 crores, and we were talked about in the last quarter to bring it down by about 13 to 15 crores. You did talk about retaining some number. So the question is, what is the level of cost in terms of cash versus the accounting, the point you were making, and that's when I got cut off, please?
So as I mentioned that in terms of cash costs on a quarterly basis, they are approximately 37 crores a month at this point of time. In accounting P&L, some of the costs get amortized in line with the revenue recognition, such as incentives.
Right. And so both the numbers it shows a higher number.
It shows 39 crores a month, whereas cash costs are approximately 37 crores a month.
Okay.
But you need to also understand that the company is getting benefited in terms of accrued revenue, which is like that's what revenue getting accounted now. So actually, the difficult month, that is April, May, June, the effect of which will be seen in the coming quarters. that is the tricky thing about the business, because you have two sets of revenue. One is the monthly payment customers who pay. The other is the upfront collections that you collect and then accrue over a period of time. The upfront collections have got severely affected in the month of April, May, and June. So July slightly improved. The thing is that if the lockdown continues and all that, we would have much more difficult quarters in terms of accrued revenue. Although the company and the management has done a fantastic job in controlling the costs. Now, we are trying to kind of hold forth right now, till things get back to some kind of a normal distance.
Actually, Mani, that's a great explanation. And the question that I have is a build-up on that now, which is, and if you can link that with paid campaigns, it will be very helpful and explain your business model as it's transitioning, which is between collections, which sound like people who are committing longer than monthly and monthly that you talked about. What is the breakup of that of the current quarter gone by? And are there serious differences in terms of the realized price because of people seeking discounting on committing longer periods in these times? If you could link that with the campaign,
okay,
then that will be very helpful.
Fantastic. That Abhishek will give you in detail the numbers. But before that, let me also tell you about the kind of shift that we had over the last 2 quarters. Now, we have the tradition of collecting upfront money from businesses, although about, say, 4-5 years back, 70% of our revenues were actually on monthly payment. I think we have done our own mistakes. We did many things, in the process. We had flipped it. Almost 70% of our money got collected upfront and 30% came on monthly basis. So we were in a desperate urgency to kind of shift our model back to the very friction-free model where people can sign in and sign out at will, which is what is the case among the best practices like Google, Facebook, LinkedIn, and others. At the same time, we wanted people to have the option of signing up more on monthly payments, so that way we kind of have a better collections also and more number of customers signing up. We did a good job in the month of Feb. In fact, if you see in the month of Feb, we had a drop in collection, but what we call it as a realizable value, which is actual revenue, which you want to reflect in the future because the monthly collections will reflect there. That has substantially improved and that has shown a stable trend. Now, unfortunately, 3rd week of March, lockdown, COVID and lockdown, and we got a double whammy. How was the double whammy? Because earlier, we used to do upfront collections. So the collections used to go. So your deferred revenue, you would see a growth in deferred revenue. But over some period, you saw a decline in deferred revenue because the company was shifting to encouraging more customers to go on a monthly payment plan. You got it? So now what we planned is, although the intention was good, direction was right, but we got double penalized, affected for it. Now, Abhishek can explain to us. Abhishek, if you could tell us in March quarter, what was the active number of campaigns and what is the active number of campaigns now? So we will know significantly if there is a drop and what the percentage of drop in the number and the average ticket size, if there is a way to kind of tell us, there's a drop in the sign-ups average ticket size.
Right. Coming to paid campaigns, as I mentioned in my opening remarks, so June quarter end we had about 445,000 paid campaigns. March quarter end we had about 536,000 paid campaigns. Realization, if we were to derive basis top line divided by quarter end number of campaigns, that will not be the right indicator for this specific quarter, because in this specific quarter there was an impact of certain customers not opting for service. For example, when there was a lockdown, certain set of customers said that we in any case cannot cater to these particular inquiries, so please pause my services for that 1 month and resume it once lockdown gets over. As a result of that, revenue recognition obviously did not happen for certain customers for certain days. That will artificially show a drop in realization, but that is not the case. Coming to your question on out of the total collections that we had last quarter, how much would have come from monthly payment plans versus others? So out of the total about 114 crores that we collected, approximately 52 crores would have come from monthly plans versus the rest coming from upfront payments during the quarter. In terms of ticket size differential, there isn't much of a difference in terms of ticket size when we sell on monthly versus upfront, though there is 7-8% difference in terms of the discount that we offer if you pay upfront for a particular contract. So if it's a 1,000 rupee per month contract, in a monthly plan you pay 1,000 rupees a month, but if you were to pay upfront, then we allow you to take it in, say, 11,000 rupees or thereabouts.
Right. Sorry, go ahead, Manish.
Yeah. One challenge we faced during lockdown is even customers who wanted to pay via monthly ECS plan, let's say, the logistical reasons where the paperwork could not be done, So that was also kind of a challenge. So if you see the monthly ECS plan had drastically come down compared to Feb. Feb was about 70% during COVID period. I mean, during this period, I think it's come down to what, 25%, Abhishek?
25-26%.
25-26%. So, to be honest, it's like extraordinary times. We haven't seen something like this, so unpredictable, so challenging, Although the company, from the product standpoint, from many other aspects, was moving in the right direction, but this kind of unnatural, kind of a artificial kind of a challenge that has come, we're not able to kind of understand how long this will continue. And unfortunately, our business and our revenues come from actually small businesses, and they are the most severely affected ones right now.
Okay. Sorry, so Abhishek, in the last call also you have clarified this on the numbers of monthly versus the other ones wherein the proportion has changed, right? And it's on the high, which Mani just called out, it used to be as high as about 70-75%, which had become 50-50. So can you just clarify that, please? When you say upfront, do you mean a longer period than a month? That's what you mean by upfront? What do you mean by that?
Okay, so
yeah.
Sure. So a customer can buy a paid listing from Justdial in two modes. Either, suppose the listing costs 1,000 rupees a month, you can either pay in a monthly payment plan where you pay 1 or 2 months of down payment, and rest of the amount is deducted on a monthly basis from your particular bank account, for which you provide us a standing instruction. The other payment mode is a upfront payment mode where you typically pay us for the entire duration of the contract, which typically is 1 year, on upfront basis. So in upfront plan, we get that 11,000 rupees upfront. Revenue recognition happens as 11,000 divided by 12 every month. So in the first quarter, I would recognize 25% of 11,000 as revenue, and rest would take as deferred revenue. In a monthly payment plan, I would get 1,000 rupees a month, which will get accrued as revenue in P&L that very month. During the month of February, we had aggressively started selling monthly payment plans, which saw a lot of traction. However, post-lockdown, that particular monthly payment plan percentage has obviously dropped because we could not send our feet on street to get those particular standing instructions signed from the customer, etc. So that is what was a drop of 70% monthly payment plans in the month of Feb to about 25-26% as of now.
Okay. This is very helpful. Thank you very much. And the last sort of ideal question, Mani, for you is, at a steady state when this thing settles down, where should this mix be between, as you said, an ideal sort of business where you have a free will to the customer monthly plan versus a longer duration? Where should things settle down? Today, monthlies are down to 25, and the other component is 75. So where should we?
So it should be the other way around. Should get back to 70-75% monthly and 25-30% on a upfront payment plan. The advantage of the monthly payment plan for the vendor is also that quite a bit of flexibility, as well as the campaign signed is kind of perpetual. He doesn't have to reset it every now and then unless he wants to pause it because he's not benefiting out of it or whatever. So that is the best for the company as well, because unproductive, definitely going back to the same client for multiple renewals is unproductive. So if you actually sign up on a monthly plan, it's better for us. So we wanted to introduce something called a setup fee, for all campaigns. So there's a basic cost which is incurred to get the campaign on board, which is kind of recovered through the setup fee. And the monthly payment is a bonus for the company, as it came. So the idea was to get as many paying customers. We've been for a while talking about how to get million customer plus customers, which is what it truly should be, because there are about 22 million businesses things, and we at least should have 1 million people paying us money, whatever the money is. And so hopefully, as COVID ends, things come back to normal. One good thing I feel that a strong realization has set in among self-employed or small businesses, medium-sized businesses, almost all businesses, that a digital strategy is where they need to focus and invest. And marketplaces like Justdial are the best places for them. So I would say, in the sense that in the post-COVID era, Justdial could be inevitable for a large section of businesses, and the money they would spend is insignificant compared to the kind of bang for the buck they would get. So that is the positive thing which I'm looking at, which I'm very happy to look forward to. But currently, we are trying to meet our expenses and our cash inflow and expenses such that we don't get into some cash loss. So I would say in a quarter or two will be even more challenging, But post that, things could be phenomenal for us, because the ecosystem is favorable for us.
And you had mentioned about this B2B portal as well, Mani. In the opening comments, I don't think there was anything mentioned there. Since you are on this thing. Yeah. When you talk about the
B2B portal, the key thing on the B2B portal is to get digital catalogs of all these businesses. The process is on. The technology is there. Everything is built. The beta site is already there. But I have to get consent from each of the business owners and their list of products in the descriptions, and the price at which they are offering. So that process is on. Now we are also employing outsource agencies and others to expedite it. Hopefully it will get done for. Now that of course will be a very rich, truly speaking, a phenomenal online experience, like for example an e-commerce equivalent for B2B, where you not only see the manufacturers by listings and generic category, but you actually go to specific products, brands, models, videos, photographs, everything. So that is this whole process is kicked. Now the content creation is with the customer approval is what is the key here. And so again the same thing, because of COVID times, there are generally the availability of customers, generally mood is not there, things like that.
And in JD, the B2C one, you have a focus on a certain 5-7 categories that are really a dominant sort of player and leader. Like we talked about, the services side of it. Would you have a certain similar focus on sort of B2B as well, which you have a strength on, you think?
So actually speaking, in B2C of JD also, the topmost keyword would be probably contributing about 2% of our revenues, I would say.
So no single category typically contributes more than 3 to 4% of the revenues. So
highest could be 3 to 4.
Is very diversified.
Okay. So this is it. Thank you very much. Yeah.
Thanks for your question. Before taking next question, I'll announce again. If you wish to ask a question, you may please press 0 and then 1 on your telephone keypad. Next question is coming up from Vishit. Vishit, over to you.
Hi, thank you. So just 2 questions from my side. One, wanted to understand, given COVID, right? I mean, what steps are we taking to ensure that consumers or customers are relatively more comfortable from just calling up a SME vendor for services, right? I mean, is there any sort of rating system or someone who's a little more careful from a hygiene standard? because this will be a perfect initiative to just improve that content and provide that additional level of services to customers, right? So that's one. And second, just on the sales processes, are we doing anything different to just ensure, because mobility for all, could be restricted for a little more longest time, right? Are we sort of ensuring that collections do not suffer because mobility is sort of reduced and our sales agents cannot travel to customers?
Right. No, of course, agents are not able to travel to the customers at all, except for certain tier 2, tier 3 cities. No other city or agents are taking customers. And that till the lockdown completely gets over, I don't think that's any possibility. So that largely depends on more to do with the government policies and then, of course, how customers are receptive. So that is there. And as far as COVID-approved employees and all that also to verify that it's not an easy task. So it's always on the trust basis that you have to go. So it's better that you don't get into those surgeries of assuring that these are all COVID unless we get into it ourselves, getting them tested and, part of the process. Which is right now with all the restrictions, I think it's a no-go zone. But see, I'll tell you one thing, business models cannot be based on flavor of the season. Although there could be a demand, the demand will also die very soon. So we can't, and this is a big shift. So what we have done well is to cover as many COVID-related keywords and categories which are, in demand, and significant amount of revenue has also come from that kind of keywords, So that is there happening. But at some point when we start lending our name to, like I said in some time back, if we kind of book a AC servicing for you or a pest control service, we will ensure that the personnel who comes there is absolutely COVID-free and there is a test done. Only those type of people are allowed to do.
Okay. So just let me put it this way. Then from a paid listing perspective, we're currently at 445K, right? Given I think mobility could be restricted for a little more while, maybe next 2 quarters, right? How do we expect, when should this come back to our original level of 35K where we were pre-COVID? Any color on that would be really helpful.
Largely depends on the lockdown, actually. Nothing much in our hand. Although customers are now trying to do something without physically being in touch with each other, they're trying to do that. So that there will be a small improvement. Little more customers will take the courage of signing up, continuing their campaign with us. But things have to come back. Certain businesses are purely depend on, people depend on logistical things and all that. So or for a marketplace to open and all that. So but we cannot predict anything unless the lockdown gets over.
Okay.
Our experience is most customers are trying to postpone, are the ones who are like pause their campaign, are saying no, let's hold it for a month to, and that is there. And new signups, obviously they're saying no, we would want to do it, but post this era and this period ends and all that. So those are the challenges.
Okay, thanks. And just from a pricing perspective, right? I mean, how should we think about how much would have been because of discounting and how much would have been because of the softer aspects, let's say the mix towards tier 2 or maybe down trading of customers or maybe customers deferring for a month or 2, right? How should we just sort of split and how should we think about realizations maybe in the next couple of quarters from a percentage basis?
See, if you see the previous quarter, it got affected because the large cities were actually locked down more than the tier 2, tier 3. So obviously the ticket size would have come down, got affected, everything gets affected. So the ticket size largely depends on when would the larger cities would get opened up and there is normalcy prevailing there. Automatically things will get back to normal. Otherwise, this will continue the way it is. As far as the businesses signing up new campaigns, well, they are taking lesser risk now as compared to what they used to do before. So the ticket size can be slightly lower, or the period committed is much lower than what it used to be. So those kind of challenges are there. So okay, let's look at the business this way. The good thing about the business is, the model is good. The company is still managing its cash in terms of cash inflow and outflow. And there is desperate need among the small businesses to get back to normal business. So there's a pent-up demand out there, pent-up demand from our point of view. The small business want to really take off. That is there. What is holding it? All this lockdown and other stuff. So we are optimistic that the post-COVID era will be fantastic. But while during this time it's going to be challenging, will continue to be challenging for this quarter as well. Is our kind of, as you know, the numbers are only increasing. Either the government takes a decision, okay, let it go free, let it take its own natural course. But with nothing of that sort visible right now, at least. So we are not able to predict anything.
Okay, thanks. And just one last small question on B2B. I think you've given enough information, but just want to understand, I think given, again, restricted mobility, given we would not be able to capture the entire catalog, and that's what we plan to do, we should fairly assume, right, it will be at least 2 or 3 quarters before we'll be able to launch that product, or we think if you can give any color on the timeline would be helpful. Thank you.
Yeah, so again, as I said, the content has to be created with both the content owner and us. So the availability, participation, everything matters. So I would say definitely a quarter more, maybe 3 to 4 months. If we can do it earlier, it will be good, pleasant surprise to the market. But 100% we are doing it, and we are doing it a much better job than what you would expect.
Perfect. Thank you.
Thanks, Richard. So next question we have from Vidit Jain from Citibank. Your line is unmuted. Please go ahead. I'll repeat. Vidit Jain, your line is unmuted.
Can you hear me?
Yes,
hello?
Now you're audible.
Yeah, okay. Hi. Good evening, Abhishek and Mani. I just wanted to ask a question back on the campaigns and collections bit. So campaigns is at 45,000, right? You lost somewhere around 90,000 campaigns this quarter. I just wanted to understand, it's fair to assume that gross ads in this quarter would have been 0, right? So 90,000 just like a mix of monthly payment plans that were stopped and a mix of annual plans that were supposed to be renewed but were not renewed. Is that a correct understanding here? And my second question is, sorry.
Yeah, so on the campaign count that we record, that is active campaigns which are being serviced at the end of the quarter. So it's a net effect. So the 90,000 number that you mentioned, there will be higher gross ads and there will be, lesser gross ads and higher attrition, which would have resulted in this negative impact of 90,000 campaigns.
Right. So I'm just trying to understand in the sense that the people who are renewing the 245,000 campaigns that were active at the end of the quarter, you mentioned, I think, that 1/3 of these are monthly plans which probably are set to recurring payments through ECS facility and are getting renewed, and a fair bit of the other 70% would be those annual plans. So just trying to get a sense of what the runoff of annual looks like for this quarter, and have you seen any change in the sense of the behavior of people who are up for renewal in July?
So of the total outstanding campaigns, approximately 20% are annual payment campaigns and rest about 30% are monthly payment campaigns. For the customers who signed up during last quarter, by and large, split was around 80-20. 80% of customers took in upfront mode and 20% in monthly plan mode. and the 20% was obviously lower as we discussed that due to logistical reasons. We anyway could not send our feet on street to customers' place to do the documentation pertaining to a standing instruction.
Yeah. Also, one clarification here, it's not always annual plan. Usually we want the customer to sign up for online plan. But in such certain times like this, they may just select a shorter period, maybe for 6 months advance payment or maybe less. So that is also kind of
right. Yeah, so thank you. I think that answers your question. The point I was trying to understand is, the behavior of the campaigners as such, as in how much of what you're seeing as runoff is passive, in the sense that, when you get an active plan or a recurring plan, it gets renewed until you actively stop it. That should be the case for the monthly plan, right? Because you mentioned it's an ECS-based plan, where you set it for a monthly payment, and unless those people for that monthly plan actively stop it, the payments will continue.
Right. So as we mentioned earlier, we pre-COVID, which was a normalized scenario, we on an annual basis used to have, say, approximately 55% retention of our paid customers, which was on the entire set. So 100 customers signing up today built in any payment plan mode, say 1 year down the line, approximately 45% used to go into year 2. Having said that, a part of the customers who did not go into year 2 could come back into the paid ecosystem 1 quarter, 2 quarters, or 1 year down the line as well.
Right. Okay. Yeah, I think that answers my question. Thank you.
Thank you.
Thanks for your question. Next we have Prince Podar from JM Financial. Your line is unmuted. Please go ahead.
Thank you for the opportunity. Mani, Abhishek, just want to understand, there has been a lot of discussion about how COVID times are behaving and the next 1-2 quarters. I want to talk more about a normal scenario. Let's assume in 1, 2, 3, whatever number of quarters, it comes back to normalcy. I just want to understand, let's say if there are 100 customers, in a normal scenario, what would be the churn of those customers? And where would that maximum churn be coming from the monthly customers or from the annual customers? So let's say in a whole year, out of, let's say 45 customers were monthly customers who were supposed to renew every month, kind of, and 65% customers were annual customers who probably would come across the year for renewal. What would be the churn in customers versus monthly versus annual? So that it gives us a better understanding of when you are planning a change of product or sales mix, how can it impact the churn ratio?
See, churn is something you should let it be as it is, whether it's monthly or annual. You don't really think about it. Sometimes the customer wants to kind of not be part of it. For example, we advertise in so many different mediums. We get in and get out, get in and get out. We like the thrill of getting in and getting out. And that's what small businesses also behave. For example, seasonal products, you will see a herd of people coming in that category, and as the season gets over, they'll get out. And so you kind of let it happen. And also, let me tell you, this is a 25-year-old business.
Correct.
And for the last 25 years, I have seen the so-called churn has been constant at around 45%. How does it happen? Mortality of businesses. 18 to 20% of small businesses don't exist same time next year.
Right.
So how will you renew the contract? Then there are people with a free will. They would want to get in and get out. So that's also there. But despite the same 45% churn for the last 25 years, we have continued to go in the number of campaigns and the number of customers paying us. For example, what it was like 25 years back, obviously you can imagine what the number would have been, to at a peak of it is 500,000 plus,
Right,
so,
correct.
This is one area which none of the online internet mediums really bothers about, churn and all those things. It's all about user delight, reward the user what he wants, and money making becomes incidental. an incidental part of it. Just come with the right pricing policy and right kind of a mix that you kind of able to grow both in value ticket size as well as the number of new people trying it out.
I agree.
When we grew the best was more to do with ecosystem at that time. I'm talking about good 5, 8, 10 years back when we were really growing at 40-50%. At that time, because we rode the telecom wave, we rode the broadband wave, and all those things. So everything was going great. Then we went through the disruption era, where a lot more things happened in internet. Billions of dollars poured in only on focusing on disruptions and all those things. The small businesses were getting affected. How can they not get affected?
Right.
Because of these
Absolutely.
disruptions. Obviously, there cannot be a reason they're dropping out because you are not effective. It's just that they're not able to run their business because of the new change scenario.
Right.
So that is
No, so actually, the basis of my question was actually what I have seen. I might be wrong. That most of the churn happening in any kind of sensitive time happens from the monthly customers. And let's go with the number which you mentioned, 45% churn, out of which 17, 18, 20% is the natural mortality you cannot help, right? So assuming just the mortality case, that 20% of the businesses go out of business next year. So essentially to grow even by 10%, you effectively have to grow by 30% on your last year customer base who has existed essentially. And obviously that 30% growth on a 400, 500,000 paid campus is not an easy task. So assuming you go more towards, or your mix goes more towards monthly customers, this churn might or might not, might also increase, which will make it even more difficult. That is where I was coming from actually.
Not really. See, actually it's not really that way. For example, if I ask you this question, if you are a customer, cost-effective customer, I give you a choice of monthly payment and upfront payment. What would you choose?
Absolutely monthly. Obviously, customer choice.
Okay, great. No worries. Great. Now let's ask the next question. So if I give you a choice between compulsory upfront payment, if I say compulsory upfront payment or monthly payment, where will you spend more value per month? Where you are likely to spend more value?
Obviously, 1 month monthly payment.
Because monthly payment plan, because of easy to pay, kind of almost like earn and pay,
That's
starting the first 2 months give in advance, you're kind of going to commit a higher value.
Correct.
More number of people will also sign up.
Right.
So the company, how do we grow? We grow with a good mix of larger number of businesses paying us money and higher value per customer. Then, do we make it like so rigid that they only get in as annual, then we'll stunt our growth, which we did it. We have not it. I can write an essay on what mistakes we made in the last 3-4 years, for 4-5 years. There is a whole lot of mistakes. So what we feel right now is the world's best models are friction free. They really do not bother about who gets in, get out and all that. They make it easy for people to get in, easy for them, even as easy as to get out. And they continue to prove value for the money spent and always remain the best among the competitive leaders. So I think we just have to focus on that. Everything will play on its own.
Got it.
Sorry,
Thanks. No. I just wanted your views on that. That's very helpful. That's very helpful. Thank you.
Thanks for your question. So the last question of the day is from Mr. Shaleen Kumar from UBS. Your line is unmuted. Please go ahead.
Yeah, hi. Thanks. Mani and Abhishek. Guys, if you allow me to be the advocate on your B2B initiatives, right? So, the argument here is, why should you guys grow if there is a very strong leader and it's been there for more than 2 decades, been going well, and network effect, classic network effect. And the better thing is, I like to draw analogy from your own platform, that you are a leader in B2C, and we have seen like 3-4 years back, there were competitors like Seneca, backed by private equity, etc., but couldn't do much, right? In B2C space. So why should you guys able to do something in B2B space where there's a formidable player, leader, etc.?
No, it's not correct to say. See, the substantial part of our revenues come from B2B play. Okay?
Yes.
So almost like 220 crores, Abhishek? What's exactly the number?
Approximately 20-22% of annual revenues, approximately 200 crores annually.
Yeah. And if you had gone back in time, it would have been higher actually in B2B. Now, see, the thing is about what is B2B, B2C? Basically, what are we trying to do? We are trying to help a buyer meet the seller or the seller meet the buyer. And that really does not matter whether the product is of B2B in nature or B2C in nature. But because of the telecom boom and the internet, early days of internet and all that, we were the darling of on the B2C side and the consumer side. But did we leave a lot of opportunity on B2B front, kind of leave it away? I mean, did we focus on it? Yes, of course, we did. Also, with the change ecosystem in the last 3-4 years, the B2B businesses have realized the best strategy for them is digital. There's nothing but digital. So there is enough appetite, enough market for a couple of B2B portals to exist out there. So there's no such thing as the market is taken away as the leader and all that. And leadership is all a matter of time. Okay, today somebody's leader, tomorrow. There was a time our market cap was more than all the Indian internet companies put together in India. Okay, and today our market cap is probably a fraction of one of those companies. So these things keep changing. I think companies have to learn from their mistakes and set it right. As far as JD is concerned, every keyword matters for us. Every business matters for us. So anywhere there's money being spent, money being made, JD should be part of it. And that will be the thing. But the product offering has to change with times. And that's what we are doing with this.
Sure. So, but the counter argument on the first thing you said, when you have almost 20% of